Week. We welcome to the program now Josh Hendrickson, Chair of the Department of Economics and Associate Professor of Economics at the University of Mississippi. Professor, thanks for coming on today.
Thanks for having me.
You bet. So just watching so much unfold here, especially in the nation's capital with respect to economic matters, and it's, I think, fair to say that's really at the heart of this debacle on the Speaker of the House situation. It really stemmed from the Speaker, Kevin McCarthy, working to, I guess, fund the discretionary aspect of government through another continuing resolution, and Matt Gaetz decided that he just couldn't take that anymore, so he invoked his privilege, only requiring one under the rules, one member, to call for a snap vote to remove the Speaker, and he did so. I've been critical, however, of Representative Gaetz in that he's offered no alternative plan other than we want to observe regular order, which would require negotiating 12 separate bills to fund the discretionary aspect of government. But, Professor, what I've focused on here on the program is we're only talking about 30% of total outlays. We don't even talk about, nor do we touch, the 70%, and that's really what's driving our deficits and, of course, layering more dollars onto our debt. Your thoughts about all that?
Yeah, I don't know whether the decision to get rid of the Speaker is the best political decision, but in terms of handling the debt, it's time for somebody to start taking it seriously. I mean, we're reaching a point where we're paying almost $1 trillion just in interest on the debt, which is more than we spend for our entire defense budget. And that's not sustainable. Right. And so something's going to have to be done about it, and they're going to have to get serious about the budget.
Right, but I think you would agree we could eliminate every dime of discretionary spending. I mean, the way the math works out now, and we still run a $300 to $400 billion deficit. We've got to get into the mandatory aspect of spending if we're going to be serious about trying to rein in the deficit and ultimately start chipping away at the debt.
Well, I think that if you look at the markets over the last week or even over the last month, they're already signaling that they don't think that the Federal Reserve is going to be able to get inflation under control. And I don't think that they're saying this because they don't think the Fed, wants to or is trying to. They're saying this because when you look at the trajectory of government debt, it just seems like the only way that this is going to be reduced is by having the Federal Reserve be the buyer of last resort for the debt and effectively monetize the debt. I mean, if you look at markets over the last week or even over the last month, like the S&P 500 is down, yields on government bonds are up, gold is up, Bitcoin is up, right? Everything that you would look at to think that people think inflation is going higher is signaling that in markets. And I think that this is just a sign that people are losing faith that the people in Washington have any sense of what they need to do to bring down the debt.
We got the 10-year that I think crossed the 5% yield mark this morning, if I'm not mistaken. We were dangerously close to it last week at 4.9 and change. I think we crossed the 5%, and that, of course, indicates that investors believe that inflation is sticky, is going to stick around. I don't even think that's necessarily driven by their thoughts about more action from the Fed with respect to the benchmark interest rate, but rather that I got to get more money given this inflation is just spiraling out of control before I lock in on a long-term basis.
Yeah, I mean, there's a certain point where inflation isn't really determined by the central bank anymore. It's kind of determined by how much debt you have. When you get to a certain point where you can't pay back the debt, I mean, you only have two options. You can either default on the debt or you can print money to pay for the debt.
Yeah. It's just sad to me that we can't seem to have a conversation about the mandatory aspect of spending, Professor, because it's so politically toxic. And therefore we're only dealing with this less than a third. And in that, Republicans say we can't cut defense, that's half of it. And the Democrats say we can't cut non-defense. And that's how we end up where we are.
Well, I think this is a problem that we've experienced for a long time now. I think if you go back to the financial crisis, I mean, there's just this constant pattern where the federal government, their sole aim seems to be to put off whatever pain that is going to be inflicted, whether it was the financial crisis itself or anything like that. So they're just constantly kicking the can down the road. But at a certain point, like, you get to the dead end at the end of that road, and there's nowhere else to kick that can. And I think that the signal we're getting from markets is that they feel like we're maybe approaching that end of the road.
The Democrats would say that, hey, it's really not an issue because they buy into the idea of modern monetary theory, MMT. What are your thoughts about that? I know you've written some about that. I'm sure you probably lecture on it as well. What do you think?
Yeah, this is a weird ideological position. So they kind of start with a basic premise where they say, like, well, like, there's no reason that any country that has its own currency would ever have to default on its debt. And so, we can always just pay for things by printing money or what have you. And that's true. We can pay for debt by just printing money. Uh, but what they seem to think is that there's no cost associated with the printing of the money. They seem to think
Right.
that printing money is not going to lead to any adverse outcomes. But we know that in the real world, there are resource constraints, right? And so printing more money doesn't actually create any more wealth. And so what you're going to end up with is you're going to end up with a lot more dollars in circulation, but you're not going to end up with any more wealth, and which means that, all this is going to give you is inflation, right? The value of your dollar is now going to be worth less than it was before.
Essentially what we've experienced since the pandemic, when we just went crazy with all these giant relief bills, and we didn't have any money to fund that. So the Fed cranked up the printing presses, and of course that, as I like to say, dropped money out of helicopters all over the country, and now we're paying the price for that. But something that really disturbs me, Professor, get your thoughts on this, is that we got the Fed over here trying to tame inflation using the tools they have, mostly the benchmark interest rate and a little bit of unwinding of the balance sheet and involvement in open market operations. But we got the federal government over here with fiscal policy that's contending with monetary policy.
Yeah, so in economics, we usually talk about, like, which policy is dominant. Is it monetary policy or fiscal policy? And under normal conditions, when you have, like, low levels of debt, like, monetary policy is the dominant policy when it comes to things like
Right.
inflation. But once you get the high enough level of debt, well, now, it becomes very, very difficult for the central bank to bring down inflation, because if that debt's not going away, it's going to be effectively monetized. And it doesn't even have to be done, like, deliberately. It doesn't have to be like Jerome Powell comes out and says, hey, we're going to just monetize some of this debt. What it is that you get to a certain point where the Fed tries to be contractionary, but there's so much debt out there and there's not really a market for that debt. And so then you get all of this turmoil in the treasury market, and then the Fed kind of says, well, I think it's time for us to intervene in this market. And so whether they intend on monetizing the debt or not, effectively, you're going to get higher rates of inflation when that sort of thing happens.
But we have a Fed chair that, unlike some of his predecessors, won't call that out. He will every time he's asked at all his conferences by the media, hey, do you think we ought to be spending less and ought to have more responsible and conservative fiscal policy? He just won't ever say that. He won't ever just tell the world, I guess, yeah, I think we ought to be talking about that.
Yeah, and I think it's always been the policy of the Federal Reserve not to comment on particular policies or particular bills or something like that.
Right.
But when it comes to broad trends in the data, I kind of reject his Powell's premise that it's inappropriate for him to comment, because Bernanke and Greenspan used to comment on budget deficits all the time, where they they would
Yes.
say, like, hey, I'm not going to talk about this particular legislation, but we do need to think about the trajectory of the debt. We do need to think about, the long-term consequences of these kinds of things. And they would just provide, some degree of warning. So as long as they're not commenting on particular policies, which is really the only standard that they've set over time, I don't think it's a problem for him to come out and say, hey, they're spending too much and this is not sustainable.
Just in a generic sense. Yeah, I agree. Professor, appreciate you coming on. Enjoy the conversation. I'm sure we'll be talking some more. Thanks a lot.
Thank you very much.
We're coming right back with more in the Element Wealth studio. Stay with us.